Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Europe podcast, available every morning on Apple, Spotify or wherever you listen. It's Thursday, the 28th of March here in London. I'm Caroline Hepker. Coming up today, the Fed's Waller repeats the phrase "no rush" 4 times as he urges caution on rate cuts. JP Morgan warns an out-of-the-blue shock could bring an end to the current market rally. Plus, watch out for the big nasties. MPs identify the major spending challenges facing the next UK government. Let's start with a roundup of our top stories. The Federal Reserve Governor Christopher Waller says that policymakers should hold fire on cutting rates in the face of new economic data. Waller cited recent inflation figures, which he said were disappointing, pointing to a stronger economy and robust hiring as evidence that the Fed has room to wait.
In my view, it is appropriate to reduce the overall number of rate cuts or push them further into the future in response to the recent data. I see no rush in taking the step of beginning to ease monetary policy.
Christopher Waller speaking there. Treasuries slipped in Asian trading in response to those comments. Meanwhile, investors are betting that the first rate cut will come in June. Policymakers are projecting 3 rate reductions this year in new March forecasts. Meanwhile, the S&P 500 index is on track for a roughly 10% return this quarter. But a JP Morgan strategist says that the market might not see an end to the historic 5-month US equity rally coming. Bloomberg's Tiwa Adebayo has the details.
Questions about when the fortunes of US equities will change have been swirling the market for months. According to one observer, though, that shift will come when investors least expect it. JP Morgan's chief global equity strategist is warning clients to diversify their portfolios if they want to avoid being stuck on the wrong side of the momentum trade. A flash crash, as he calls it, is not impossible thanks to risks hovering in the background. Looking at recent history, the rush into popular momentum stocks like the Magnificent Seven is typically followed by a correction. It's happened 3 times since the global financial crisis. In London, Tiwa Adebayo, Bloomberg Radio. Now, Ozempic, a drug that Novo Nordisk charges almost $1,000 for in the US, could be profitably produced for less than $5 per month. That's according to a study by Yale University, King's College Hospital and Doctors Without Borders, who say that the blockbuster drug could be manufactured for between 89 cents and $4.73 for a month's supply. That includes a profit margin. Now, the drug industry often defends such high prices by saying they make possible the research and development that leads to breakthroughs. Novo declined to provide specific production costs for Ozempic, but told Bloomberg that 75% of its gross earnings go to rebates and discounts to ensure that patients have access to the products. Janet Yellen says that she expects insurers to help cover the cost of rebuilding the Baltimore Bridge. The US Treasury Secretary's comments come after Joe Biden called on Congress to approve funds for the Port of Baltimore's reconstruction. The Transport Secretary, Pete Buttigieg, told Bloomberg this isn't a political issue.
This isn't going to happen overnight. The original bridge took about 5 years to put up, and this isn't going to be cheap either, but we do have emergency relief funds to help in these kinds of situations. We really cannot yet say what the total price tag will be.
Although Buttigieg couldn't give an exact number, the cost is expected to run into the billions of dollars. A lengthy shutdown will also cause chaos for commuters and for trade. The port is one of the top US ports in terms of volume and value of cargoes in the US. Now, a watchdog has laid out the scale of spending challenges facing Britain. The Public Accounts Committee identified nearly 20 areas in need of billions of pounds of government funding. Bloomberg's Chris Pitt has more.
Hospital buildings, defence equipment, affordable housing, school maintenance. Just some of what the Public Accounts Committee report calls big nasties. 19 problems they say essential spending can no longer be put off for after years of neglect. The committee of MPs from different parties thinks each one of these will cost the government billions. This as Britain is in the grip of a fiscal squeeze, with the debt to GDP ratio now close to 100%. In London, Chris Pitt, Bloomberg Radio.
And French Prime Minister Gabriel Attal has pledged more unemployment welfare cuts as he aims to press on with President Emmanuel Macron's economic reform agenda. The changes, which Attal expects to implement in the autumn, include minimising the maximum duration of welfare and cutting payments over time. Macron's leadership was centred on economic policies designed to overcome decades of weak growth. But with a European slowdown, unemployment is rising and the budget deficit has widened beyond government targets. Now the objective is to reach full employment, Attal said on Wednesday, although the modifications pose a risk of a backlash ahead of the European elections in June. Those are a few of our top stories this morning. Now, I mentioned at the start of the programme the Fed's Governor Christopher Waller saying that there's no rush to lower interest rates, adding that recent economic data warrants delaying or reducing the number of cuts this year, at least according to him. The comments come ahead of fourth quarter US GDP growth, which the market expects to be confirmed at an annualised rate of 3.2% later. And if that wasn't enough for you to start your day with, then up pops JP Morgan to warn that the biggest risk to the 5-month rally in US equities is an out-of-the-blue shock. Well, joining me now to chew all of this over is the only man you really want to hear from on these occasions, our global head of macro analysis, Mark Cudmore. Mark, good morning. Great to have you with us on Bloomberg Radio. Lovely to hear from you. Waller used the term no rush 4 times in his remarks. That's no mistake, surely.
It's absolutely right. It makes sense to me. Good morning. I mean, I just don't know why the Fed would be looking to cut rates, given the economy remains very strong. We've passed through the main disinflationary cycle from base effects. So the only way inflation's going to come down from here is if we get a severe kind of contraction in the economy. And there's just no sign of that yet. Of course, we could get a black swan or something like that, but I don't think the Fed will be in a rush to cut rates. And I know Powell, in the very recent Fed meeting, kind of insisted that they're still planning on 3 rate cuts this year. I really think that's the maximum they'll get away with without a severe kind of crisis coming from nowhere. And I think it's most likely they might even struggle to do more than one.
Well, do you think that the Fed and markets are actually on the same page then at the moment? Will they continue to be? Because that's been quite a struggle this whole year.
So I think that the market has now got more in line with the Fed, but I think that they're both still in denial of the data, right? And I think that everyone is trying to believe in this idea that the bond sell-off, must be over and we must be back into the long-term bond bull market. You've got to remember that everyone in markets today, their training is a 40-year bond bull market. So the default for all of any relevant person in markets is that you just buy bonds, you buy the dip, and so and also this idea that the Fed is going to cut preemptively, and the Fed itself has said, look, we're desperate to cut rates, even though there's no justification for it yet. And so I think we've seen this the last couple of years. People keep on trying to trade the return of the bond market preemptively, prematurely, and getting it wrong and getting burned. And I think they're just going to get burned again this year. It will take a severe downturn in the economy to justify rate cuts. And if that's the case, then equities better watch out. But I'm not expecting that.
OK. So what do you expect then from the US GDP data today? And then, of course, got the inflation data tomorrow, even though markets are closed.
Yeah, look, the core PCE is much more interesting. I mean, GDP, it's too backward looking. We know the economy is really strong. As I said, everyone is finally accepted, hey, the economy is held up really well and the economy is strong, consumers still spending. So instead, the obsession is trying to find the forward-looking catalyst, and that makes sense. Core PCE, I think, is a very relevant print. And if anything, that might cause a little bit of a hiccup in bonds next week. Yields go a little bit higher. It's a very weird one to get it on a Friday when every market's closed in the US. You do sometimes get, when we've had non-farm payrolls come on Good Friday before, you sometimes have the CME open futures for a little while to get some reaction, but we're not actually getting that from the PC tomorrow. So basically the real reaction to this is going to come in Monday morning trading in Asia.
Yeah, absolutely. What else did you make of the JP Morgan warning that the thing that's going to stop US equities is an out-of-the-blue shock? I mean, it's a funny phrase to use, isn't it?
I feel like to rob a term that seems to be quite popular with the millennials and Gen Z today, you can't just manifest volatility into existence. You need a catalyst. And I think, people are getting so determined to find some reason for volatility and risk aversion that they're now just going like, we have no idea what it's going to be, but something's going to go wrong. I think, you can gather all the firewood in the world, but you still need something to ignite the fire. You still need a spark. And I just don't see the imminent catalyst on the horizon. And, it goes back to that classic phrase that, pessimists sound smart, but optimists make money. And at the moment, I think that the big macro tailwind is that in the December Fed meeting, Jerome Powell made very clear that this is a Fed that is desperate to cut rates, despite the fact that there isn't economic justification to do so yet. And that was reiterated only last week. And that is the macro backdrop. I didn't expect that before the Fed meeting in December, because that was the mistake that was made in 2021. The Fed kept policy too easy for too long and ignited a bubble, which then had ramifications later on. But they're just doing that again. So they're igniting another bubble in assets. And yes, we're going to get valuations that might be stretched already. They can keep on getting more stretched. But, and it might be volatility because they're stretched. But you're just not going to get any major risk aversion without a catalyst. And I guess J.P. Morgan are basically saying there is no catalyst. And so why would you be bearish? You're trying to predict a black swan. And by definition of what the idea of a black swan was, that it's not something you can describe or predict because you've never seen it before.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond. Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts. You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com. Our flagship New York station is also available on your Amazon Alexa device. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker. Join us again tomorrow morning for all the news you need to start your day right here on Bloomberg Daybreak Europe.